financial planning and analytics with life cycle costing, higher margins even without revenue growth. And well, I will be moderating, as I say. And well, for today, you can use the chat to submit your questions. There is a questions and answer space that you can give us your questions, also to do some chat. This meeting will be recorded, and we are going to start right now. We have some housekeeping rules, and well, thank you for joining us. And in this case, use the question and answer, ask questions, and the attendee chat. And for the poll questions, you will see that they will appear in the slides in front of the presentation. So try to don't enlarge the window areas so you don't hide the slides. It's very important to submit your polling questions in order to have your full CPA credit. And that's why you need to attend the whole presentation, submit all the polling questions, and complete the evaluation form that you will see at the final of this hour. And well, part of this is because we have in IMA, we have the share interest group related with profitability and cost management, where this is a space dedicated for learn, do networking, and leading some competencies that we as management consultants need to get enough experience in order to enhance organizational value and improve profitability and cost management process in our organization. So we invite you to join. You will see this Q code. In the case, if you are an IMA member, there are a lot of activities that we have inside of this share interest group. And if you are not a member, we invite you to do your registration for free, and we will see there. Today, our speaker is Jan Embelsvag. He is a professor from the Norwegian Institute of Technology. He has he has done many research related with life cycle cost, profitability, and cost management. One of his specialties is with energy and utilities organizations. And also, Roger Medina is an Oracle EPM consultant. He has experience in modeling. At the final of the presentation, you will see their emails and contacts if you want to chat with them. And well, Jan, welcome to, as I said before, welcome to IMA, to the Institute of Management Accountants. And well, the floor is yours.
Thanks a lot for the excellent introduction, Pedro. So let's see, I assume we just click on next. Yes. Okay, so first a little bit about the content of today's little talk. Here is a nice figure I found Southwest Environmental Finance Center had put on the internet, which is a really, really good illustration of how it is. It's so easy to see what we just pay for the purchase, but then you have all these other things to think of. And this is, of course, very good illustration of life cycle costing. And first, a little bit about the background. What problem are we trying to address? Then, of course, the old classic case, cost versus expense. Then a little bit about activity-based costing, life cycle costing, and of course, Monte Carlo simulations. Yeah, and a few concluding remarks to the end, of course. Yeah. Okay, so first, learning objective. So hopefully you will understand how to avoid some of the common pitfalls in cost management and life cycle costing in particular after this talk. Then the main components of what we can call activity-based life cycle costing and the different types of uncertainty that we need to analyze and make right decisions concerning costs and risks. And here's a pull first, the first pull, and let's see. Let's give you 30 seconds or something like that.
Answering this question is very important to understand which of the following best describes your organization's current cost management approach. So it will be like letter A, traditional cost accounting, like general ledger focus, or perhaps you are running an activity-based costing, or you have an isolated life cycle costing, or perhaps you already are using an IRAD approach using activity-based costing and life cycle costing techniques, or perhaps you don't have a formal cost methodology at this time. So please answer
Yes.
one of the options. Thank you.
Mhm. Yeah, I think maybe I should just click and see. Here we go, the pull so far. Yeah, this is actually much better than
what do you think?
I've seen elsewhere. Yep, Pedro, you were going to say something.
Yeah, what do you think about these results that you are looking right now? What is your main impression about the?
I was going to say that in my experience, if you look at the front slide where you have those two roads with the traditional costing and the alternative costing, you saw that on the front slide the traffic was most heavy on the alternative, what we are talking about here. But my experience in industry before I became an academic is that traditional cost accounting is hugely dominating the way things are done. And these results are far better than what I was really thinking. So that means that the IMA members are much more progressive on this than most other ones. This is very good.
Okay. Oh, perfect.
Okay, but then I guess we can go on. Yeah.
Yes.
Yeah. So a little bit background first. And of course, life cycle costing came first in the 60s, originally from the Department of Defense in the US in order to procure the right weapon system that gave them the lowest direct costs over the lifespan. But this, of course, has now changed. Direct cost is today often a just small fraction of the total cost. So now it has been lifted to more total cost and therefore also cost management in general. And the reason for this growth is the overall system complexity growth. Today's systems, whether you talk about a car or a plane or whatever, or organizations, are much, much, much more complex than in the 60s. And this has, of course, led to a growth in indirect costs. And on top, with the increased integration of systems, we have also seen a number of complex risks that wasn't there in the 60s, for example. The internet, for example, have given a lot of new risks, as just one example. And what is really important to recognize is that costs are committed early. So basically, what we say is that when you develop the concepts for something, that concept development may only cost 5% or something like that of the life cycle cost, but it will commit 60% of the actual costs of the products later on. Then we have design and engineering, another 20%, testing, another 10%. So that means in order to just design the product, you have already committed about 90% of the cost of manufacturing this product or life cycle cost of it. I think on this slide, we're talking about manufacturing cost, total manufacturing cost. Then, of course, we have the process planning. And in the end comes the big chunk called production. But of course, once products have entered production, you really have a small solution space of influence. And as you can see here, it's estimated to be just 5%. So when I worked in industry, I always told my people that the primary responsibility for production is to meet the budget, cost, time, quality. If we want to really improve cost effectiveness, the solution is in the engineering, in the procurement, or basically in what takes place before you start producing something. And this, of course, leads us to the very crucial difference between cost and expense, which is, I think in all companies I have worked, and this distinction is lost. And I say that when I worked in companies, I had an executive position. I was not there as a financial planner or an economist of some sort. So I was senior vice president for a number of companies. And some of the accountants, they told me that, well, you have to pay for the total expenses anyway. So they didn't quite capture this distinction, but it is really important. And in order to just illustrate it, you see here a small machine. And if job A consumes 30% of the capacity and job B 55% of the capacity, then logically speaking, the costs should follow the same fraction. But then, of course, comes the big question, what do we do with the surplus? And this is where I had lots of debate when I worked in industry with the cost accountants. And some of the cost accountants said that, well, we have to cover it anyway, so it should be assigned to the products. My response to that was that no, it shouldn't. The products should be costed on the basis of the capacity they used, and then this surplus capacity should be written off at the bottom line of the company as a sort of unused capacity cost. This was legal in the US before the, when was it, 2030 something? No, 1930. But then came the Depression, and these laws were changed. If you read books by Gantt, you know, the guy behind the Gantt diagram, he was super clear on this, that to distribute the surplus capacity to the products, he even used the word mental illness, which is, of course, a crazy term to use, but he was very, very much against it. So, but the point today is that because we have the legislation on one hand and the internal cost management on the other hand, we really need two solutions. And why is this crucial? Well, cost is a measure of the resource consumption related to the demand for jobs to be done. And this is something that you can only estimate because, like you saw on the machine, you can never buy a machine that fits exactly your demand. It's that simple. Expenses, that's a measure of the spending that relates to the capacity provided to do the job. So that's basically what you find in the general ledger. Indirect cost has then also been growing, as we mentioned earlier on. And this has, of course, brought a number of challenges to this distinctions. And that means that correct capacity planning has become really a critical skill in order to eliminate or reduce non-value added costs and expenses. So the situation we are today is basically with the, there's a lot of systematic wrong costing, let's call it that. And what's really a problem with this is that the cost estimates will vary according to the volume you sell. So back to the machine, you saw that the sum of the demand was 85% of the capacity. Now, suppose that it falls to 50%. Then, of course, by putting all the expenses on top of these two products, they will go up in cost. So this will keep varying, depending on the situation, and that's not a very good way of moving into the market. Perhaps a much bigger problem, or at least an equally big problem, is that these 15% is being transferred as a part of doing business. It's not made explicit. Basically, we build waste into the system, and this ruined the overall competitiveness of the company. And just because of this volume dependency, this becomes a self-fulfilling prophecy. So if you have lack of volume, then the cost increases, which make it harder to sell and obtain volume. And this is a downward spiral. Reversely, of course, if the volume is increasing, then the cost estimates will fall. So this makes both financial planning but also cost management difficult. Why? I used a word from Gant. I had a big laugh when he was very vocal on this. So, but the reason is basically rules in most countries. And as I said, you would need two systems to do it correctly. One for cost management purposes internally, and one for external reporting. Basically, we need to avoid this. Don't smear the cost all over because, like some of the accountants have told me, that we have to cover them anyway. No, if you want to do something about the cost, you need to make it explicit. It's only what we measure that gets done. And if you had a big chunk at the end of your cost overview that said unused capacity, I think most executives would be scared if they saw the number that you would actually put there. So how do we do it correctly? Well, we need to determine what's called maximum practical capacity. Some companies use maximum capacity, which is literally speaking 100%. But that is, in practice, impossible. The argument they have is that, well, it will drive continuous improvement, which of course is true, but I think it can also perhaps be demotivating if it's way, way apart from 100%. So that's why we say use maximal practical capacity. That's a term I think most people in a company will understand and see as logical. This will, of course, remain unchanged as long as the structure and the complexity is unchanged. And cost objects carry only the costs they should. So, for example, you could end up in a situation where you have a facility that is unprofitable, or a factory is unprofitable, while all the products or projects are profitable. That will indicate that basically we have a too large facility or factory. But that's a very important signal to send, because that means we have to do something structurally in order to improve the cost performance. So then, of course, this has been complicated since Gant wrote, I think he wrote about this in the 20s, but of course back then it was literally only direct cost. So he had very little conception of indirect cost, and not to mention the explosion of costs objects that came later on. Henry Ford famously said that you can have any T-Ford you like as long as it's black. And with one object, cost assignment becomes super trivial. So, but with today's number of cost objects, this has become quite complex. And of course, and I assume all of you know activity-based costing, and it's a necessary tool in order to make this cost assignment correct and therefore make decisions correctly. And the potential is massive. This is from a report that I was co-author of many years ago, if I remember correctly. And this is basically, you see manufacturing, which is a highly repetitive industry, you see that the share of so-called value-added activities, it's much higher than in construction. 62 versus 10%. It's 6 times more value added in manufacturing compared to construction for the same amount of input. Then also in construction, you have a lot more support activities, but look at the huge amount of non-value added work. It's almost depressive. But it also shows that there's a huge potential in project-based industries for this kind of thinking. I have submitted 2 papers that you can read that Gary Calkins and I wrote about how to calculate the hourly cost rates, because that's in project-based industries, this boils down to primarily the cost rates that you use. And that has to be done correctly also. Otherwise, you build waste into the cost rates. Okay. So that leads us, of course, to the ABC principles. And this is stuff you know. And of course, at the bottom, you have the cost objects of various sorts. And it could be products, services, customers, suppliers, organizational elements. It can be a lot of things. And they consume activities. And to trace this, we use activity drivers. And activities is basically what gets done in a company. And my experience here is that with most of these models, if you have 50 activities, that's a suitable number. Don't make it too many or don't make it too few. I'll talk more about that later. And this importance of this is that in order to improve cost, you actually have to change what is done. You have to change the work. That's the really, really big insight of ABC, in my opinion. Not just that it's a more accurate way of calculating the cost, because that you can do when you have the second stage in place, which you trace by resource drivers. So when you put this in place, you can, yes, more accurate cost estimates, absolutely. But the crucial thing is how to change it, how to improve it. And that's where this activity element is so critical. And here is a case I did 20 years ago, my goodness. And this is a manufacturing company. And, you know, you have the general ledger. We do our activity analysis, interviewing people, finding out how they spend their time, et cetera, et cetera. And then we take a lot of machinery and that kind of stuff and directly attribute it to the activities. So we end up with a bill of activities that is much more accurate than the general ledger. Then we use the activity drivers and we assign it to cost objects, and in this case, products. But what was interesting in this company was that we also did the same for cost of capital. So you have the net balance, you can calculate the cost of capital on the different kind of assets, you can make a bill of capital, you can use capital drivers and calculate actually the economic profit of the same cost objects. And you know, economic profit is the net operating profit after tax minus cost of capital. And that tells you a lot of interesting things, and that I will show to you shortly. And what we did in this company after we had done that was that we actually turned the system around, and we said that the activity drivers will more or less remain constant. It takes a lot of process work to improve them, but from a year to another year, they will kind of stay quite constant. And by doing that, you can reverse the model around and you can actually make an activity-based budget. And this we used and actually ended up quadrupling the bottom line over 4 years. It improved 100% every year for 4 years. Amazing improvement. But the top line stayed the same. So this was all about how to do things differently, how to improve execution in the company, remove waste, and those kind of things. Here are the results, and as you can see on the total rectangle to the bottom right, 955 products, 300 million in revenues, and 16.4 million in net profits. Then you can see we split up the products in red, yellow, green, and you have a single, double, triple. So the triple C, for example, you see there were 19 products selling for 42.8 million, but losing, let's see, 6.9 million. That's very strange. I mean, triple, that it's a big volume product that should make a lot of money. If you go down on the other end of the C, you see the single C. That's more like you would expect. 300, or I have some dust on my screen. Let's see, 591 products selling for 13.8, but losing 14.4 million. And you can see the whole C group. The B group, they are those who are operationally profitable, but they're not able to carry their cost of capital. And the A are the ones who can carry both the cost of, no, not the cost of capital, sorry. They could carry a certain return level that the company had. And I think it was 7% between the yellow and the green. So this is a way to present the results. And you could talk a lot about this, but the main thing is that most products are unprofitable. 733 out of 955. That's not good news. And the other big finding we did was economies of scale are destroyed by rushing other products through the manufacturing line. And that's what killed all these triple C products. They should have made a lot of money on them, but they didn't because of that. Then if we take a look at the economic profit results, this is the economic profit calculated using weighted average cost of capital, which was different than the return target that the company had. And actually, you can see less than 10% of the products can actually carry both cost and capital. Less than 10%. No low volume product can carry their cost of capital. None of them. And we developed a bunch of tactics for improving the results. And this is just the highlights, of course. Of course, sell more of these, obviously. These improve work processes, look at pricing, cut complexity. For example, if you have 10 variants, do you really need those 10? Maybe 5 would be enough, for example. Even look at outsourcing or e-commerce on the procurement side to cut procurement costs. And of course, these ones, the single C, they led to the difficult discussions, including cut. So this was done, like I said, every year for 4 consecutive years, quadrupling the bottom line. So that leads us to the second poll. What are your biggest challenges in cost and profitability analysis? And here you can hook off 2 if you want to, up to 2. Is it lack of reliable data? Is the complexity of indirect cost? Is inadequate tools and technology? Difficulty in modeling uncertainty? Lack of management support? And resistance to change or / cultural barriers. So take 30 seconds. There's no right or wrong answer here. I'm curious to see the results. Oh, we're halfway, folks. Soon. Let's see if we can make all of you. 105 have submitted. That's very, very good. A few more seconds. Remember, it's no right, no wrong. So, okay, we have more than 70%. Just keep filling in so we go to the next slide. Because that's also an important insight that I've seen over the years when I've done process analysis, that after you talk to roughly 10, 15 people, the answer starts to converge. It's very difficult to learn anything new after you talk to 10, 15 knowledgeable people, actually. It's in a company. Okay, let's see. Yeah, lack of reliable data, that is indeed complexity of indirect cost, yes. Particularly big multinationals can be very, very complex. That's my experience too. Tools and technology, yes. Yes, yes, yes. Yeah. Yeah. I think in my experience, once you've done the analysis and you start to change things, then actually the one on the bottom becomes a big one. And the big problem is if you come in and you hear that, well, this is how we do it here, or we have never done that before, and or even worse, that one we have tried. So when you have all these kind of explanations, then you know that this can be, which is a difficult job to change. You know. But very interesting results. Very, very good. Okay, but now we have kind of given a little bit introduction. Now we can go into the more lifecycle costing domain. And what we now just touched upon briefly is the activity-based costing part. So that's kind of the foundation. Then we need to add the lifecycle costing aspects and, of course, Monte Carlo methods, or basically a way to handle uncertainty. And the reason for that is, of course, that with lifecycle costing, you have to look way into the future. And there are many types of this. Unfortunately, I wish there were only one, but there isn't. And first is the type of life cycles. We'll look at that shortly, the market life cycle or the product life cycle. Then we have a number of perspectives that we also have to look at. We can also look at other life cycles. Here, Investopedia had a nice figure of a so-called industry life cycle. You can do it there too. It's just that you will need other data, but the same method can be applied. Okay, so this is what we're learning in marketing. When I did my master and PhD at Georgia Tech, I had marketing, and this is a curve, I think actually from the compendium, if I remember correctly. And this is very straightforward. It's a classic investment case with cash flow. So we'll just move on. Then we have the product life cycle. This is where this whole discussion of cost and expenses become very important, because as you can see, all the manufacturing and all the demanufacturing is processes. There is a lot of equipment, which means there are capacity issues, there are supply and demand issues, etc., etc., etc. And this figure I actually made, I think, for my master's thesis in '93. And it's still true. That's why I use it. So basically, you have mining, processing, manufacturing, distribution, and then we sell it. And this has been the classical approach to manufacturing. However, with the increase of environmental legislation, also customers have started to demand, then there has become a lot more interest around what do we do after we use it. The first thing, we have to actually get it back in some way, but then we can start working on it. We can take it apart. We can even destroy the material, take it apart, and in the worst case, incinerate the rest material. And there is always something to dispose of. To analyze this kind of product life cycle, that's much, much more complex than the market life cycle. The perspectives here, we also need to keep in mind. So the production perspective is the one we already know really well. This is the way it's always been done. The other one is also very well established. This was actually the original perspective of life cycle costing. And as I mentioned, Department of Defense in the US started with looking at it like this. But lately, let's say the last 20, 30 years, two more have come that are really important. Societal perspective. The whole issue about liability cost. I remember Exxon Valdez accident, for example. That was a huge cost that Exxon had to pay up. And I think most companies are also feeling really heavily on this less tangible cost. Brand name, customer loyalty, corporate image, stakeholders, etc., etc. All these issues, you cannot find probably any of these except liability cost if there is a case on your general ledger. All this is quite difficult to estimate. And then, of course, you have the worst of them all, and that's externalities, basically costs that are not even captured by the economic system one way or the other. And here you can see a couple of examples. We know this is a real cost. We just don't know how to calculate it. Lots of ways have been attempted, and you can argue with them back and forth. But I think the most important thing to recognize is that these externalities are real, and they are becoming more and more a part of the societal perspective. So they are in many ways becoming more and more a license to operate. I think that's the most important thing right now. When it comes to the types of life cycle costing, we have, generally speaking, four. We have analogy models, parametric models, and engineering cost models. All these is basically engineering tools. As an example, analogy model, you have, for example, the steel weight and the cost of producing a steel section in a ship. Then you have another steel section, you know the weight, but what's the cost? And then sometimes we just scale it up based on the weight. Parametric model is similar, except we have more parameters. Not just the weight, for example, but it could also be the shape of it. It could be plate thicknesses, etc., that could be added in and make it much more accurate. Then, of course, you have the engineering cost models that try to build up the whole picture, but excluding indirect costs. To get the indirect costs correct, you need cost accounting models. And this is what I did in my PhD and master at Georgia Tech. And also you'll see the book later on, etc. So to make an activity-based lifecycle costing model that can do both direct cost and indirect cost, that's the clue. And since we're talking about the life cycle, there are a number of uncertainties, of course, because we're looking about future things. The system itself might be so-called ontologically uncertain. That means it cannot really be fully understood. I'll show you an example of that. Managing risk can also be epistemically uncertain. Epistemically, that means if we spend huge amount of resources, we can figure this one out. So it has to do with our knowledge level of the system. So with lack of knowledge, you end up with uncertainty. And of course, the future itself is inherently uncertain. So with these three, we need to find a way to handle it. And we must model it. We cannot ignore it. That's the most dangerous thing to do, particularly when you're looking at life cycle costing, where you might look at assets that are 10, 30, 50, or even 80 years. So you must model it, even though you know the modeling is not perfect. For example, the power grid, that's a good example. Take a look at, well, I'll show you soon a graph, but here we have real-time production and consumption. We know that storage is very, very difficult due to the scale. And the market does not distinguish generators according to their qualities. For example, differences in reliability, availability, and maintainability. And of course, rapid growth in system cost due to variable renewable energy sources. All all this have made the power grid difficult, or almost, I would say, impossible to fully understand. So it's ontologically uncertain. Yeah. Here, for example, we have wind power production in the northern part of Norway. And you can look at this and you see it go up and down and up and down. And of course, you can use the average number. But one thing that's 100% sure is that if you use the average number, you are almost always wrong. You are either too high or too low. Reality is either too high or too low compared to your average. So in order to model these kind of things, I typically do use the average, but I also use the standard deviation to capture the variations of this. That's very important. And then, of course, you have an uncertain variable. But to estimate what the wind power will be in exact time, impossible. And what we've seen in Germany, for example, is how this has led to a rapid growth of system cost in the grid. And this system cost is essentially an indirect cost for the grid. 20 years ago, one of the key people in Europe on grid reliability, Herbert Saurug, he told me that they had one event per month. In 2023, they had 50 per day. This, of course, makes the whole planning, the whole costing, everything much, much more complex. So that leads us to the next poll. Which improvement would create the most impact for your business? A, better visibility of true cost and cost drivers. B, more accurate pricing and profitability insights. C, ability to simulate future scenarios with risk and uncertainty analysis. D, improved alignment between finance and operation. E, stronger support for strategic investment decisions. Come on, folks, 30 seconds. Are we almost halfway? Yeah, 51%. Yeah, 70%. Yeah. Let's go on and see the results. Better visibility, yes. Yes. Yeah. Yeah. Interesting. My experience here is, I think all of them are very good, really, and I can see that you have placed yourself almost all over the place. In my experience, the alignment between finance and operations should also be, could definitely be better. Today, at least where I used to work, I think in all the companies, it was not enough communication, to be honest, between those two. So, but this is very, very good answers, all of them. I think I would put one on all of them myself. So, yeah. All right, let's go on. So that leads us to the final topic, handling uncertainty. So basically, what's important to realize is that uncertainty is just the state of being uncertain, doubt, hesitancy. It's not necessarily loss or gain associated with uncertainty. It is not the known with certainty, basically. It's not the unknown, because if it's unknown, you can't put it in a model. So essentially what I like to think of it is a measure of the quality of availability information. That I think is a okay way of looking at it. How do we do it? Well, here we have some examples. from some papers I've written. So here we have discrete distributions. So that means that the uncertainty variables are just on these columns. You cannot have values in between. If you think you can have values in between, then we need continuous distributions. And here we have a normal distribution and a triangular distribution. Which one you use, that is entirely up to the situation to determine. So how do we calculate this? If it was these discrete cases, you can kind of multiply probabilities and outcome and sum up. Yes, it can work. It can be a huge amount of work, but it will work. But it's much better to use numerical methods, particularly Monte Carlo methods. And also, let me just emphasize that in the continuous cases, in those two distributions, the normal distribution and the triangular distribution, to handle them exact math is very, very difficult once you have many of them, which leave really numerical methods as the only practical approach. Both cases, you need to understand statistics a little bit. So let me have just a very quick example. Here we have two assumptions. We have a simple model. Product cost equals direct cost plus material. Very simple, just plus. That's it. In a Monte Carlo simulation, what you would do is then you pick number according to the uncertainty distribution on direct labor and on one on material, and you add them together and you store it in the system. So for example, $4 for direct labor plus 6 for material is 10. 12 plus 8 is 20, 20 plus 15 is 35, etc., etc. You do this thousands of times. The more, the merrier. And then you store all this data in the Monte Carlo simulation software, and then you can perform a statistical analysis. And in this case, here you can just see a histogram, but you can do all kind of statistical analysis once you have the data. This kind of modeling has almost no limitations. Sorry. So let's have a look. This is one of my first cases actually done. This is a platform supply vessel operated then in the 90s in the North Sea. It's called Far Scandia. And here we built up a complete model covering the cost of ownership. And just some results. For example, in year 7, you see the maintenance cost of using marine gas oil, MGO, would look like this. And you may wonder why all these bumps? Well, that has to do with how frequent certain maintenance jobs were done, basically. And in order to identify the most cost-effective way of handling this, we could use the sensitivity chart. And here you see this is for the same year 7. You see the annual running hours, basically how much you use the ship, is of course the number one driver. That's obvious. Then you see the hour consumption intensity, basically what you pay the crew, and they are doing the jobs. And now comes all this maintenance intervals and jobs, as you can see, and you can basically understand in nitty-gritty details how year 7 could be improved, or how the overall entire cost of ownership could be improved. By having this tool, you have exactly an attention directing tool, which is exactly what ABC is also. Activity-based costing doesn't give you an answer. It gives you, it attends your direction or your attention to a certain problem area. And with this, you can do it even much more accurately. And you can cover the entire life cycle. Now, I mentioned it earlier about the level of detail. That's very important. Attune the level of details to the case. And here we have basically the modeling uncertainty on one hand versus the communicative effectiveness on the other hand. So you can see, for example, if you are very rough estimates, yes, They give relevant but imprecise information, can be easily communicated, might ignore statistical realities, might be not so effective because people can say that, well, you didn't include this, you didn't include that, this is the problem, this is this, and so on and so on. However, if you go overboard in the other domain, too many definitions, and this is about the, we talked about the number of activities. If you have too many activities, it can be really difficult to understand what is the true difference between these activities. It becomes difficult to communicate and therefore difficult to manage and therefore actually so detailed that it's ineffective. So you need to find the right balance. So I guess it was Robin Cooper, who said that it's better to be approximately right than exactly wrong. And this is all about that. Cost management is all about that. So risk is not just bad things happening, but also good things not happening. Therefore, you should not minimize risk. The ontological risks cannot be minimized because they are inherent to the system. You cannot handle them. You just need to understand them as far as possible. You can't really understand them, sorry, but you can understand the implications of them on your analysis. Then the epistemological risk can be minimized at a cost. You can spend more resources to understand things more in detail, yes. But risk towards the future cannot be minimized except at a cost. You can do more analysis, but there is always a residual risk on the future. But also keep in mind that by minimizing risk, you also might minimize opportunities. So this is all about finding this right balance. Understanding the drivers of performance, the right risks can be taken, and the rest you manage, essentially. So now I think it's over to you, Roger.
Thank you very much, Jan. Let me start with the demo by sharing my screen. So this is the process when we do profitability analysis in a customer using Oracle EPM. Today, I will show this strategic planning and the EPCM and do some of the analytics with some tools that are included on the EPCM tool of enterprise profitability and cost management. So let's first start with the planning tool. Thanks for this nice photo to our community manager from Sweden and the town where she lives. I will start with the strategic modeling part that shows us some example on how to do that. So I will open some data. We'll go with the different data that is here. I will go with the income statement. I want to make the simulation for data on the cost of goods sold, go simulation, and in simulation I start setting what are the assumptions that I need. So the most important assumption is what is the probabilistic distribution that I want to use. I will use normal because I know that in this case my data is aligned to the normal distribution, and in the past has proved me that information, so I can predict that in the future that can be aligned to that. As you can see here, the number of trials is moving. That means that it's going as planned. I set up for 500 trials, so it's not a lot, but it's enough to make sure that the forecast data is created. So the data has been already created. In a normal project, the data will be exported through a job to our EPCM solution. In this case, I have all the data already there. So let's start with the modeling tool. Let's go to the designer of the process for the waterfall setup on the cost allocations. And you can see the different components on the cost allocations. Let's go to the activity costing, because that's what we have been discussing mostly on this webinar. Let's see how we are doing that in the tool. In the tool, we select the source data. In this case, is the entity and accounts and activity. We have no activity because there are no source data on the specific activities. Actually, that's the purpose of this process, to allocate the data that comes not assigned to activities to be assigned to activities. So here you can see all activities will be assigned based on a driver that is on the account dimension. So let's see how the data will look. Here is a Smart View, that is a tool to easily interact with your EPCM tool through Excel. I have pre-opened the activity dimension, so you can see how it is organized. I have basically 3 hierarchies of activities: business support, production, and customer servicing. And in the case of production activities, these are the activities that I have been using. The driver that I was talking before is related of how much time is being assigned to each of these activities based of observation that we have done, or based on the interviews that we have done to some representative members of the different components on the activities. So that's why is the activity time split. So I'm gonna do the canceling. I will not run the process right now because it will take a few minutes on this. But let's go to the rule balancing. It's a very nice way to confirm that your calculation is behaving as you expected, and everything goes well. So here you see the different activities is the same activities that I had before, and how the cost is being assigned to the different activities and the allocations are being done. Here, the important part to go to the detail is that all the remainder is close to zero, almost zero. It's not going to be exactly zero because, rounding parts. So everything is working as planned. So let's go now to the intelligence part. That is probably the most interesting, and where you can actually make a lot of money without having to sell more, is on the profit curve. That is simple as a concept, but it's very useful. So here is just a graph who starts with how many customers you have: 1,684 customers. 46 of those customers are unprofitable, ones that you have correctly assigned the costs and expenses of those customers, servicing those customers and selling to them. And 53 are non-profitable. So that means that if you were only focusing on this 46%, your profit will be for last month 1,229,000. But as you decided, probably consciously or non-consciously, to sell to a lot of non-profitable customers, then your profit diminished to less than 100,000. So let's analyze this in detail, how it goes. You can see here we start with your most profitable customer is to the left, that it deliver you 1,569. But then you can see each customer that you have adds a little bit but as less profit it adds, of course, the curve goes in a flat part. That is the maximum part. This maximum part will be 1.2, almost 1.23 thousand, and then the next customers are taking out a little bit of profit. So it is normal that you have some unprofitable customers. Yeah, but not a lot like this in this case. You can see here that, for example, you can see you have more non-profitable customers than profitable customers. And if you see the last customer, the least profitable customers, it diminishes your profitability from 126,000 to 96,000. That's 12,000 negative margin that you got from that customer. That is even more than the most profitable customer that you have. So let's make a quick analysis on, let's say, the worst. I would say that usually well, as I said, it's normal to have some unprofitable customers. So let's think that it will be normal, probably, if you are a well-managed company, to have some unprofitable customers, probably finish your profitability curve like that. But let's see what happens here when you have this as many customers like this. So let's analyze it from a sales perspective. You can see that between the Linda and Kathy, these two reps have almost more than almost 60% of the non-profitable customers the company have. So is that part of your strategy, that these two reps are focusing on non-profitable customers? Probably yes. Probably you're gaining market share, and later you will get those unprofitable customers to be profitable. But are you sure? That's the big question here. So let's make the same analysis, but in the other side. And here you can see that it is at the same time it's spread between two reps too. I mean, the most profitable customers are being managed by two reps, same as the most unprofitable customers. So is that the correct way? We don't know. That's something that you need to decide, but at least now you have the information, the data that you want to show. So if you have more questions or you want to know more about this, please write me. This is my email, rogerm@azurenordics.com. Thank you very much, and I will get back to you, Jan and Pedro.
Do they see the slides now, Pedro?
The demo, the 49, yes. The conclusions,
okay.
Yes.
Yes, okay. So basically, traditional cost accounting have a rare view focus and often leads to systematic misallocations. And of course, ABC and LCC help to correct this. That's one of the key things. Another one is that costs are committed early in the life cycle, making early cost visibility and control very, very important. You need to design the costs out, basically. It's too late once you build something. By integrating ABC and LCC, you can align profitability with strategy across products, customer markets, etc., etc. You have a lot of possibilities, basically. And of course, in the end, Monte Carlo simulations provide a practical way to analyze uncertainty, manage risk, and support more robust decisions. I think that was it. I think this is the last version of that lifecycle costing book, and there's a lot more written about these things in that book, of course. I think also I've shared a number of articles with you guys. And I just submitted 2 more, actually, by Gary Corkins and me, where we discussed the project-based industry, how to calculate the hourly cost rates. So that's it, folks. Over to you, Pedro.
Yeah, no. Well, thank you for this opportunity that you are giving us to conduct this presentation, and we're going to give you a certificate of appreciation that if you see my screen.
No, I see additional literature.
Okay, but what about now? There is a small delay. Thank you very much, Jan, for your presentation, for the effort that you put on this webinar, and during this presentation, I tried to respond the questions that you submitted. If you have more questions, we are open to solve those questions and submit those questions to Professor Enver Basuk. So for all of you, thank you for attending to this webinar, and I hope to see you soon in other webinars that we have at the IMA Philippines chapter, and also at the IMA Profitability and Cost Management Share Interest Group. Thank you, all of you, and have a good day, good afternoon, or good night.